Welcome to the Hidden Profits Beyond Compliance Continuing Professional Education course. This course will provide an overview of 3 proven and practical approaches to starting and growing an advisory practice and to discover hidden profits within your client's business as well as within your own firm. We will tie together the 3 approaches with example client communications and deliverables, and lastly, we will touch on the benefits of building and growing an advisory practice in your CPA firm. This course was written by Peter Mayers and Frank Rochon of Growth CPR and is being delivered by me, Frank Rochon. Before we get into the meat of the course, I'll tell you a little bit about us. Peter Mayers is a CPA with an MBA. He was a partner at KPMG where he founded 2 practices. Peter has also held executive and C-level positions with a global mid-market company and small businesses. The benefit of a diverse career is that Peter has had clients and has also been a client. I worked with Peter at KPMG and Outsourced Partners International, where we focused on business process outsourcing. We pioneered outsourcing finance and accounting processes in the early 2000s. I have also worked in industry, thus sharing Peter's experience of both having clients and being a client. Our firm, Growth CPR, helps CPA firms build and grow their advisory service practices. We believe that advisory is one of, if not the only source of organic growth left for accounting firms. Now, at the conclusion of this course, participants should be able to give 3 examples of business owner pain points, list 4 criteria that indicate that a business may be having cash management issues, describe why pricing is the best lever to increase gross margin, list 3 types of costs, give an example of spans of control, and give an example of brain versus brawn. The advisory services that we are going to cover address 3 of the top objectives of CPA firms today. First, CPA firms want to gain more clients. Second, they want to make more money per client. And third, they want to offer new, valued, and differentiated services to the market. And, perhaps most importantly, these advisory services help keep your client in business. Much has been written about the commoditization of compliance-based services and the need to build an advisory practice, and it's all true. CPA firms are constantly being admonished to build an advisory practice. It's a common refrain and great advice, but no one talks about the how or the what. Providing sales training is helpful, but it doesn't address the root issue. Specifically, what are you selling? And why would a business buy those services from you? That's what we will be presenting today, the what and the why. One of the best lessons that we learned on both sides of the fence is that the key to any business, including CPA firms, is to know who your customers are, what their particular pain points are, and how the business uniquely solves those customer pain points. It's always about the customer, and conceptually, that makes sense. But practically, it's not always that straightforward. We've talked to dozens of CPA firms, and when we ask about client pain points, these are some of the most common responses that we get. Yes, they're important, but are they really top of mind for clients? And from a client's perspective, I doubt that any of these issues are the ones that are keeping them up at night. In fact, if we're being perfectly honest with ourselves, we all know that these aren't the client's real problems. The CPAs that provided these responses all share one thing in common. They are confusing what they know and what they're comfortable with as opposed to understanding and addressing the real pain points of their clients. They're seeing the client's business through their own lens rather than from the client's perspective. They have solutions that are looking for a problem. I'll tell you a quick war story to put this in perspective. Now, back in the early 90s, a family friend of Peter's acquired a business. He brought Peter on board as the CFO. The business was a $35 million third-party administrator, a major medical insurance broker. Within the first 8 weeks of starting, bedlam broke out. The key legal terms weren't defined in the asset purchase agreement, and the company sued the previous owner for breach of contract. A third of the clients left as the market heard about the lawsuit, and then a major underwriter of the company declared insolvency. So the CPA firm, they didn't know whether we're going to survive as a business beyond 6 months, much less through the end of the year. The firm that was doing the audit wrote a management letter about a lack of updated depreciation schedules for the business, stale checks that needed to be escheated, and the lack of current account reconciliations for non-material accounts. This CPA firm, they knew the numbers, they knew the compliance rules, but they didn't know the business. They knew from being around that the business had going concern issues, but they didn't offer any advice or suggestions or any ideas to help address our main pain points. So Peter often tells this story as he found it to be truly humbling because it made him realize that he was no better than this when he was in public accounting doing these same audits. So the lesson there is that building an advisory practice starts with understanding the pain points of your clients and providing solutions that address those pain points. How it turns into an advisory practice is then that these solutions should be practical and repeatable with measurable outcomes. So, what are the real client pain points that CPA firms are uniquely positioned to help with? Surveys of millions of small to medium-sized businesses consistently rate cash management, low profitability, and cost containment as their top challenges, i.e. their pain points. These are the issues that are keeping them up at night, and these are the pain points those businesses need sound advice on. These are, in fact, the opportunities upon which to build an advisory practice. So, we will cover 3 advisory services that are practical, repeatable, and have measurable and valuable outcomes. Most importantly, they address real client pain points, and the services can be provided using your existing staff with 0 incremental costs. These are advisory services that are at the nexus of what is important for your clients and their business, as well as concepts that CPAs are familiar with and comfortable talking about. Specifically, these are cash management, gross profit improvement, and expense containment or reduction analysis. So before we dive into the first one, cash management, let's hit review question number 1. When surveying millions of small and mid-sized businesses, one of the following was not identified as a top challenge or client pain point. A lack of reliable company cars. B, cash management. C, low profitability. Or D, cost containment. I'll give you a moment to think about it. The answer to question 1 is A. Surveys did not identify a lack of reliable company cars as a top challenge. B, C, and D were identified as top challenges or pain points. The first how-to advisory service is cash management. If only it were this easy, right? Businesses who are experiencing cash flow challenges won't typically be this blunt in acknowledging their need for help. Small and mid-sized business owners know their customers, they know their products and services, and they know their operations extremely well. But admitting that they don't have a firm grasp on cash flow fundamentals can be a blow to their pride and their ego. Now, a few statistics to put this in perspective. 70% of businesses that fail were profitable when they closed their door. 30% of all businesses will die due to cash flow issues, and yet 83% of business owners possess a basic or failing grade in financial literacy. There are over 1 million businesses in the United States with revenues between 1 million and 5 million. And of that, 85% of those businesses report being concerned about cash flow, and yet less than 3% of those businesses are being helped by their financial professionals. So, in a nutshell, cash flow is very likely a major pain point for your clients and thus an advisory opportunity for you and your firms. Now, statistics are interesting, but how do you actually identify these opportunities? What are the warning signs and indicators that a business may be having cash flow issues? And where are these businesses? The best place to look is within your client base and ask the following questions. Which of your clients had a significant percentage of their accounts receivable past due? Which ones have a days sales outstanding averages that are above the industry norm? Which clients have a significant percentage of their outstanding accounts payable past due? Which clients are continuously going into their line of credit to deal with quote-unquote emergencies? And which have less than 90 days of operating costs in cash? These are just some of the indicators, and the more indicators that a client has, the more likely they need assistance with their cash flow or cash management challenges. Now, unfortunately, just because you know a business has cash flow issues, it doesn't mean that the CEO or the owner knows that they have a cash flow problem. In the mind of the CEO or the owner, their pain point is the stress they feel about cash management. So part of discussing cash management advisory with your client is relating how your work will alleviate the stress and improve the business's outlook. Now, there are many one-time cash management engagements that you could provide and are good and beneficial to the client. Examples of these one-time cash management engagements includes that you can evaluate their order to cash and procure to pay processes and make improvement recommendations. You can recommend that they take deposits for large orders or implement same-day invoicing for invoices above a certain clip level, or develop a process to follow up on invoices before they come due. You could teach a client the basics of cash flow and set up a simple spreadsheet to help them manage their cash flow more intentionally. We'll show an example of this in a few minutes. And if you really want to impress them, you can help them find and implement an automated cash management solution. So, single cash management engagements like these are good, but recurring cash management engagements are great, but probably not for the reasons that you may think. So as we noted earlier in our statistics, most business owners are not financially literate. You are. Your business expertise and insights could mean the difference between success and failure for your client. And cash management is fundamental to the success of every business. So, what does a recurring cash management engagement look like? Cash management engagements can be a systematic and productized offering to your clients. This chart is a simple and straightforward statement of work. It summarizes the task to be performed, the frequency of the task, and the estimated time it takes for each task. We don't have time to delve deeply into each of these tasks, but you can appreciate the overall framework and the comprehensive approach. In general, there's a weekly conversation with the client about accounts receivable and accounts payable management, identifying which customers are and are not paying, and what actions need to be taken by whom and by when. There's also consideration of any large accounts payable invoices or payments that are coming due. There's also a monthly review of the cash forecast, identifying any risks or changes in the business conditions since they may impact the future cash forecasts, as well as looking for ways to improve the processes and accelerate the order to cash cycle. Each quarter, there's a review of the sales forecast and the implications on projected cash flows. This review provides some advanced warning for the business to take proactive actions if required, such as reducing costs or deferring a planned investment. And then, lastly, there's the annual budget planning and long-term goal setting. This chart is a recipe for how you offer cash management advisory services, and you can expand and tailor the tasks and frequencies to meet unique client needs, including factors like seasonality of sales or payment behaviors of material customers or any type of these events. Using this approach, you should be able to clearly articulate and demonstrate the value of having deeper insight into and control over cash management. Having less stress and greater peace of mind is a great value proposition to a business owner or CEO. And all of these tasks should be familiar and should be comfortable concepts to you if you're taking this course. Companies that manage cash on a daily or weekly basis are far less likely to experience cash flow issues than a company that manages cash on a monthly or quarterly basis. And that just makes sense. Forewarned is forearmed. So here's a quick example that highlights the importance of cash forecasting. There was a client several years ago that had a bi-weekly payroll cycle. So obviously there's 26 pay cycles per year, and 10 months have 2 pay cycles, and 2 months have 3 pay cycles. So given the odd numbers of days in a year, leap years, and timing of how the calendar falls, every 11 years or so, there's a 27th payroll, and this is on a cash basis. It actually makes a great trivia question. Now, this particular client had highly restricted bank covenants, and they weren't aware that in 2015, the 27th cycle payroll issue would occur. Fortunately, we were doing a full year cash forecast, and we identified it. Recognizing the adverse impact that the 27th payroll would have on their bank covenants, we were able to work with them in a proactive manner to take preemptive and mitigating actions to ensure that they didn't violate these bank restrictions or bank covenants. Forewarned is forearmed. To close out the cash management advisory service section, I'm going to show you a snapshot of an actual cash forecast that we have used with several clients. It's easy to set up, and it fits the client needs well. This is a daily cash forecast using Excel. The columns are the days. It has historical information, which are shaded tan, as well as what is forecasted, which is shaded blue. The rows are the material expenses and when they're due to be paid. The model starts with the beginning cash balance. It has all the material expenditures and expenses, when they expect to be paid, and then at the bottom are the forecasted collections based on forecasted sales and historical collection. And then at the very bottom, you can see that some of the ending cash balances are shaded red. These are conditionally formatted cells that flash red when the cash forecast, or the cash balance, is forecast to drop below a predetermined level. We charge $4,000 to $5,000 to tailor this cash forecast model to the business, and then for one of us to train the controller or the accounting manager on how to use and update this template. In summary, cash management is a much needed and relatively easy advisory service that you can offer to your clients on both a single engagement and a repeat engagement basis. A quick review question. A company that frequently draws on its line of credit to pay regular expenses is likely to be a good candidate for cash management advisory. A, true, or B, false? I'll give you a moment to think about it. The answer is A, true. This is one of the many indicators that a company may be experiencing cash management issues. Let's look at a second question. Which of the following would not be a one-time cash management engagement? A, development of a process to follow up on invoices before they come due. B, reconfigure the order of the bills and coins in the cash drawer. C, help implement an automated cash management system. Or D, evaluate the order to cash and procure to pay processes and recommend improvements. I'll give you a moment to think about this one. The answer is B. Reconfiguring the cash drawer is not a one-time cash management engagement. The other three are excellent examples of one-time cash management engagements. All right, our second how-to advisory service is gross profit improvement. Now, ask yourself this question. How are you or how is your firm different from other CPA firms? It's really hard to differentiate yourself in an industry where everyone has to play by the same rules and deliver nearly identical reports. Fortunately, advisory services don't play by those same rules. Gross profit improvement is a highly valued advisory service that immediately captures the ear and attention of business owner. It also happens to address one of their top pain points, which is low profitability. The identification of opportunities for gross profit improvement takes the same approach as cash management. The first and best place to look is within your own existing client base. Actually, let me preface this section by saying what we really love about this advisory service is that not only is it about growing a business and growing profitability for a client, but since all this information is readily available, calculating these metrics should be standard practice on every engagement. It's great training for the staff and helps them to understand the business and not just the numbers of the client. So by definition, 50% of all businesses perform at or below the 50th percentile. It's just math. And among your client base, there's a lot of businesses that have profitability pain that could use your help. Obviously, there are independence rules that must be complied with, and gross profit improvement engagements may not be able to be performed on attestation clients. However, if you could make 5 or 10 years worth of audit fees in a single gross profit engagement, would you give up the audit? Now, don't respond now, just hold it. We're going to come back to that not so rhetorical question very shortly. Now, back to uncovering these opportunities. Looking in your own existing client base, you must first determine how the client stacks up to the competition. There are numerous subscription services available in the market. They're not that expensive, and they're well worth the investment. An example benchmark report is on the screen. It provides information by industry, by NAICS code by region, and by the size of the business for which the data is provided. It's high level, and that's okay. We're going to show you how to take this data, analyze it, and find hidden profits. In this example, the business is clearly underperforming. They're at the 30th percentile for gross profit, the top red circle, and in the 40th percentile of EBITDA at a measly 1.1%. And it's no surprise that because of their low profitability and EBITDA numbers, they're probably having cash flow issues as well. This is a client that needs help. So how do you begin to analyze gross profit? The DuPont Model is the time-tested recipe for analyzing a business's gross profit and uncovering hidden improvement opportunities. If you're not familiar with the DuPont Model, you need to be. Let's walk through it briefly. It identifies the underlying drivers of gross profit and in those little green boxes in the upper right. Gross profit is simply sales minus cost of goods sold. Sales are simply sales price multiplied by the quantity sold. Cost of goods sold is simply the cost per item sold multiplied by the quantity sold. These are terms and concepts that are very familiar to us. And as I noted, most, if not all, this information already exists in the work papers or is readily available. Using the simplicity of the DuPont model, you can now ask interesting and penetrating questions like, what is the gross profit by SKU? Which SKUs are the most profitable? Which are the least profitable? Which customers are the most profitable? Which distribution channel or salesperson is the most profitable? What day of the week or month of the year, or which is the least profitable day, week, or month, and why? You can see how this framework readily lends itself to extension and getting granular into what the drivers of sales and cost of goods sold are. So a spreadsheet is helpful in analyzing this, but the value of visualizing the data cannot be overemphasized. As they say, a picture is worth 1,000 words. So using the data from the DuPont model, you can create a scatter plot of sales and gross margin to easily identify problems and opportunities. This is a modified scatter plot chart based on actual client data. Gross margin is on the y-axis, and net sales are on the x-axis. We inserted the blue line on the graph to depict this company's marginal cost of 24%. When we dug into analyzing the customers that were the primary purchasers of these categories, we identified a single customer that represented just over 35% of total net sales with an overall gross margin of 18%. That customer's gross margin was 6 percentage points below the business's marginal cost. That means that for every dollar of revenue for this customer, the company was losing 6 cents, before even taking into consideration any fixed costs or SG&A allocations. That one insight, identified early on in this engagement, resulted in the client negotiating their contract with the customer and improving their projected annual gross profit by over $300,000. Not bad for a few hours of work. Now, gross profit improvement requires knowing which levers to pull, and the DuPont model provides the framework to identify those levers. There are two primary ways to analyze gross profit. The first is to analyze it by product or by service. As we saw in the previous example, not all revenue is good revenue. If the marginal cost of the product or service is higher than the associated gross profit, that's a sure road to bankruptcy. The marginal cost of every product and service must be known, and minimum gross margins must be established. Doing a time series analysis of unit sales and gross margin will shine a light on fluctuation in sales and gross margins, and the anomalies that are identified can be further analyzed to understand the root cause, and corrective actions can be developed. The 80-20 rule, which is familiar to most everyone, stipulates that 80% of consequences are driven by 20% of the causes. In other words, 80% of sales would come from 20% of the customers. In this example of a fruit and vegetable wholesaler, 80% of the sales came from only 10% of the products. That insight opened the door to exploring a convenience pricing strategy to dramatically improve profit, and then ensuring that the business has the appropriate processes and controls in place to capture changes in the cost of goods sold, and updating their pricing schedule and contracts is key to maintaining and enhancing profitability. The other primary way to analyze gross profit is by customer or customer segment. And just like the questions we went through previously, you can ask, who are the most profitable customers or segments? What do the most profitable customers or segments have in common? How are they most different from the least profitable? Is there a dependency on a single or a small number of customers? What are the profitable and unprofitable distribution channels? And these are all great questions, and the data will lead you to where the hidden profit opportunities lie. One challenge you'll likely encounter is that information that most businesses gather about their customers is incredibly sparse. This, too, is an excellent opportunity to help them enhance their data and the information that they collect about their customers. That enhanced information will allow them to further refine their product and service offerings and tailor them to the specific and unique customer needs that they're trying to serve. Now, the ROI from improving gross margins can be significant. In this example here, moving a $20 million company from the 30th percentile of gross margin to the 50th percentile, which is the industry average, would add more than $1 million to gross margin, not insignificant for a $20 million company. And this advisory service isn't a theoretical exercise. This is a practical and repeatable advisory service, leveraging some industry benchmark data, the DuPont model, and applying your own analytical skills and experience. You have the necessary ingredients to identify underperforming companies within your client base and within your market, and deliver significant, tangible value to them. One last comment on profit improvement before we move on. The absolute fastest way to improve gross margin is to increase prices. Pricing is the easiest lever to pull, but it's often the most neglected. You simply can't say increase your prices. There's a large body of research on pricing strategies and behavioral economics that are beyond the scope of this webinar, but let me touch upon 3 important points. First, companies should not compete on price unless they are positioned to do so. Amazon, Walmart, Home Depot, and other gigantic companies are always going to be able to offer better prices and a greater selection, and there will always be someone willing to be the lowest price out there. It's a race to the bottom and not a race that any business should want to win. We like to ask companies when they start to fret, my prices are too high, or my competitors' prices are so low. If low prices are so important to your customers and you're not the cost leader in the market, why do you still have customers? And they give us this kind of funny look, and the reality is not all customers are looking for the lowest cost. Many are looking for personalized attention or an eclectic selection, or they want a specific quality or are concerned about the service or the buying experience. In many cases, folks want the after-sales support. Competing on a unique value proposition is absolutely critical. That's the second point. Every company should have a unique value proposition. Third, businesses must know what their competitors are doing. Have them make a purchase from them. Get a sense of their pricing, the quality of the product or the service, or the level of customer service. How easy the competitors make it to buy from them and to complete the sales transaction. All of these factors play a role in the customer experience and what the customer is willing to pay. And as an aside, you can apply these exact same principles to your own practice. Don't compete on price. Define your unique value proposition and compete on that. And lastly, know what your competitors are doing. So, time for review questions. A time-tested model for analyzing a company's gross profit is the A. Colgate model, B. Discounted cash flow model, C. DuPont model, D. Black-Scholes model. I'll give you a moment to think about it. The correct answer is C. The DuPont model. A Colgate model is used to demonstrate good dental hygiene. The discounted cash flow model, or DCF, is a valuation model. And the Black-Scholes model is used to determine the value of put or call options. A second question. The easiest lever to pull to improve gross profit is A. Pricing, B. Headcount reduction, C. Spend less on raw materials, or D. Reduce sales. The correct answer is A. Pricing. Headcount reductions, which is B, could reduce SG&A costs. Spending less on raw materials will reduce cost of goods sold and improve gross profit, but it's not an easy lever to pull. And D, reducing sales will likely reduce gross profit. Okay, now we're in the home stretch. The third how-to advisory service is expense reduction or expense containment analysis. Now, for us, this is our least favorite section because emotionally, it's about cutting and not about growing. We just talked about improving gross profit in the previous section, and now, somewhat ironically, I'm going to be talking to you about how to lower a vendor's gross profit, such as life, I guess, or at least business. So just like the other two advisory services, we're going to use the same approach to identify opportunities. The first and best place, again, is to look within your client base. We're going to use the same benchmarking information we used for the gross profit analysis, only this time we're going to use the operating expenses comparative data. A note of caution is to pay attention to the relationship between the gross profit and the operating expenses as a percentage of sales. You'll notice how operating expenses move in a highly correlated manner to gross margin. They increase roughly at the same pace. When the operating expense is in a higher percentile than the gross profit, that suggests that there's an opportunity to reduce costs. Now, any fool can reduce costs, and honestly, most of them do. These are the classic people that know the cost of everything and the value of nothing. On the surface, cutting costs is easy. Cut everything by 10%, make the budget work, and you make it home in time for dinner. But making indiscriminate cuts may damage the very essence and fabric of what makes a company unique. For example, if you're cutting customer service, that may be the very factor that customers value the most. thus leading to reduced sales because of departing customers. Then the remaining customers continue to have problems with after-sales support, which reduces margin further, which then creates the need to cut costs further, and so on and so on and so on. And before you know it, a vicious cycle is started, which is very difficult to reverse. So, what's the company to do? The key to cutting costs is to cut the right cost. The first step is to categorize every cost as being either strategic or non-strategic. Strategic costs are defined as all things that clearly bring in business and improve the bottom line. Typically, strategic costs include salespeople but not sales managers, advertising but only if it's effective, manufacturing, and costs of goods sold, although they need to be ruthlessly managed, and R&D costs. That's it. Non-strategic costs are all other costs necessary to run the business. Administrative costs of all types fall into this category: managers, clerical support, rent, insurance, office supplies, and so on. Strategic costs should be monitored and managed to ensure they are truly enhancing the top and bottom lines, and they should be treated more as an investment than an expense, since there's a clear expectation of a return. When a company needs to reduce expenses, strategic costs should be the absolute last items cut. On the other hand, non-strategic costs should be viewed as a necessary evil, the less the better. And rather than having to justify eliminating or reducing non-strategic expenses, which is the position that most people take, the burden of proof should be on justifying why the expenses are necessary in the first place. I have countless horror stories and examples of expenses run amok, and I'm sure you do as well, because waste is everywhere. Ruthlessly examining every cost, every vendor expenditure, and having to justify the why can produce considerable savings, and this is a very simple concept. Applied with commitment and resolve, it is more powerfully profit maximizing than almost any other process or framework ever conceived. It's a common sense approach, and yet the fact that hardly anyone practices. It creates an enormous opportunity for companies that do. Now, when you're examining non-strategic costs, it's easier to get cost reductions from suppliers than it is to cut personnel costs. Aggressive vendor management should be first up. The biggest obstacle to reducing vendor cost is most often the business owner. They don't want to be the bad person to the vendor with whom they may have a long-term relationship, and that presents an opportunity for the CPA. The secret to vendor management is to not have a dog in the fight or have emotional attachment to the supplier relationship. CPAs can deal with the facts and the numbers and ignore the associated emotions. Also, ask for price reductions first before you actually switch vendors. Those who ask for more usually get more. You'll be surprised at how eager suppliers will be to lower their prices to keep the business. Everyone knows it costs more to obtain a customer than it does to service an existing customer. Use that knowledge to your advantage. Also, be aware of a psychological trick known as Weber's Law. In a nutshell, it states that small changes of generally less than 10% are too small to be noticed by people. So an individual would not be able to detect that a stack of books which weighs 110 pounds weighs any more than a stack of books that is 100 pounds. So what does this have to do with pricing? Well, well-known brand companies raise prices 2 to 4% multiple times a year without anyone realizing it. What may have started as a bargain for a business could quickly and easily be transformed into a very profitable customer for the vendor. And of course, the biggest cost reduction of all is to eliminate the expense entirely. Find the waste and root it out. Now, the last group of expenses to examine are people costs. These are the most difficult and emotionally charged decisions and are oftentimes the third rail in reducing costs, but you have to look at them. A good place to start is spans and layers of control. Teams should have high spans of control, meaning the number of staff per manager. Call centers are a very good example of this. A single manager can manage 40 to 50 call center employees because the process is governed by scripts and there aren't many versions of those scripts. Processes in teams that require much more interpersonal guidance and direction will have lower spans of control. FP&A groups are a good example of this. Removing management layers is a highly effective approach for materially reducing personnel costs without materially reducing headcount. Now, smaller companies may not have as many obviously redundant positions or positions with overlapping responsibilities, but the opportunities are still there. There's also a concept we call brain versus brawn, and it's pretty simple. You want $100,000 a year people doing $100,000 a year level work, and conversely, $40,000 a year people doing $40,000 a year level work. Too many managers and upper management perform tasks and are assigned responsibilities well below their pay grade. Fix that work alignment, and the savings can be substantial. Another key topic here is employee longevity. An employee who has been with the firm or company 20 or 30 years oftentimes will end up compensated so far outside the market rate of that position that the company becomes paralyzed. They don't know what to do because this person has been loyal, but we've seen many situations where a relatively low-level administrative person was making more than some managers. It's a result of 3 to 5% pay increases over a 20 to 30-year period. Resolving this is difficult, but there are proper guardrails that can be implemented to avoid repeating this mistake in the future. And then, lastly, poor performers need to be addressed. They not only hurt profitability, but they also damage the culture and morale of the business, and everyone knows who they are. I heard a great quote many years ago. You don't get what you measure, you get what you tolerate. Don't tolerate poor performers. Now, I appreciate that we may come across as heartless or cavalier when talking about cost cutting as an opportunity for CPAs, and that's not our intention. Our career has been working mostly with companies that were underperforming financially. When a company's survival is at risk, you quickly learn which costs are strategic, which costs aren't, and what actions are needed to get the company back on solid financial ground. And this is a basic framework to achieve that. On that note, let's have a review question. Blank is the concept of having $75,000 per year employees perform appropriate job functions as opposed to jobs that can be done by $35,000 per year employees. A. Cost cutting. B. Brain versus brawn. C. Span of control. Or D. Strategic versus non-strategic. I'll give you a moment. The answer is B, brain versus brawn. Cost cutting, A, is another way to refer to the advisory service of expense reduction. Span of control, C, is the ratio of managers to their staff. And D, strategic and non-strategic, are types of costs. So let's pull all three of these advisory services together through a real-life example. A banker referred us to the owner of a $60 million company, and the banker said that the CEO was concerned about some cash management issues, and they wanted to get a better handle on their cash and their ability to forecast. So we proposed to develop a cash forecast for them and to train their controller how to use it, update it, and do the appropriate projections. A perfect example of advisory service number one, cash management. We heard his pain point, proposed a needed service, and created a profitable advisory engagement that has a $5,000 price tag. The CEO also mentioned that his controller had been with him for 30 plus years, and the company may have outgrown his strengths. He thought he might need a fractional CFO or a consultant to provide oversight to make sure that the accounting processes and internal controls were appropriate. That's a good thought, but we really didn't feel that they needed a fractional CFO, but rather some guidance via checklists and processes. So we pulled together a list of quarterly tasks to give them the assurance that the finance department had good hygiene, that they were doing the things that they were supposed to do and doing them correctly. That list of quarterly tasks is on the screen. Now, while the list of tasks is primarily compliance and internal control focused, the quarterly financial trend analysis includes a review of expenses, of trends and opportunities for cost reduction. And that was attractive to the owner. And frankly, that's actually what sealed the deal. So, advisory practice number 3, or advisory service number 3, expense reduction. We priced the expense reduction as a percentage of savings on top of the $2,500 per quarter fee, so it was a mutually beneficial engagement that met his pain point and is a profitable advisory engagement for us. Here's the quarterly report that was delivered. I know it's hard to read on the screen, but it's just like every other agreed upon procedures report that you issue. It says what I did, what the results were, notes, and any recommendations for improvement. Now, how did we get to advisory service number 2, profit improvement? My email to the owner when I sent the report included this language at the bottom. Because they were having cash flow issues, it seemed a reasonable leap of logic that they would likely have challenges with their gross profit. Now, this was a throwaway line, but people who ask for sometimes get more. We proposed that we do a gross margin analysis by product, customer profitability study, etc. And it caught his attention because what business owner doesn't want to make more money? So we compared their performance to industry benchmarks. They were performing at about the 20th percentile. A relatively quick analysis of the product and customer service profit margins using the DuPont Model uncovered hidden opportunities for profit improvement. And within a little over 4 months, we were able to recommend changes in pricing processes and strategies. They renegotiated contracts with 2 of their largest customers to their advantage using data provided by us, as well as our help in honing the articulation of the value proposition. We also made other recommendations to improve their internal costing process. Those changes have resulted in the client moving from the 20th percentile in gross margin to the 50th percentile in just 90 days after adopting our recommendations. The fees for this gross profit improvement engagement are contingent and are based on realized improved profitability. These fees will exceed $250,000 and will not have required any incremental cost to deliver. And the client is happy paying these fees because he's making more money. Now, I have to note this is not typical for a firm when it first starts out with an advisory practice. We were able to leverage our many years of experience starting and building advisory practices. It does, however, highlight the process of starting the relationship with 2 smaller engagements and then progressing to the larger opportunity. Now, a few minutes ago, I asked you whether you would give up an audit client if you could make 5 or 10 years worth of audit fees in a single advisory engagement. And as you can see, it really was a rhetorical question. So I hope your answer now is a resounding yes. The opportunities are out there, and advisory services should be a major driver of growth and profitability for CPA firms. In the beginning, there are $1,000 and $5,000 and $10,000 advisory engagements. In year 2 or 3, you start making the jump to the $25,000 and $30,000 projects. Building an advisory practice is not about selling $50,000 projects right out of the gate. It's built upon small engagements that are practical and repeatable. These engagements form the bedrock of an advisory practice and are easy for partners, managers, and even staff to identify and to engage in discussion with business owners. Now, in this slide, I'm not going to go through each of these bullet points, but overall, the profession's biggest challenge is change. CPAs know they need to build an advisory practice, and the tangible benefits are outlined below. When you download the PDF of the presentation, I encourage you to compare your advisory practice or the advisory practice of your firm and assess whether you're positioned to capture the benefits of a growing and robust advisory practice. There are short, medium, and long-term advantages and benefits to this, and you want to make sure that you're aligned with that. Build an advisory practice is a common refrain. The advice from most advisors to the accounting industry is sell more. That's like telling someone to run faster. It's not sound advice unless there is coaching, or in this case, an actual offering to sell. This course covered 3 practical and repeatable advisory service offerings that are the what and the how that you should be selling. I'd like to thank you for taking this course, and I hope you gained valuable insight into building and growing your advisory practice. Our contact information is on the screen, and we're happy to answer any questions that you may have. It was our pleasure to create and deliver this program, and we look forward to having you attend other Growth CPR programs.